The yield curve inversion has been a great predictor of recessions. I've highlighted this indicator a few times over the past few years. Every time it dipped below zero, a recession followed in about 1 to 2 years, as you can see with these shaded rectangles. The timing, it isn't exact, but it is good enough for us to make better financial decisions, which I'll get to in a moment. We saw a brief dip leading up to 2020, and then in mid-2022, it started dropping further below zero. And already, the stock market, it has dropped into bear market territory. The S&P 500 is down more than 20%. On top of that, we've also gotten back-to-back quarters of negative GDP growth. However, due to past lockdowns, stimulus, and other market manipulation from the government, we're getting some mixed signals. There was a lot of excess liquidity pumped into the markets, which is still sloshing around. The most recent third quarter report showed positive GDP growth. Also, unemployment numbers are still near all-time lows. But based on the Fed continuing to increase rates further, it looks like unemployment will be moving higher. There's an economic pullback underway, and we're starting to see companies take action. Amazon, Alphabet, Meta Platforms, and Microsoft, they've all frozen or started to slow their hiring. And big layoff announcements, they're starting to pick up. Here are some recent headlines. So Ford plans to lay off 8,000 employees. Tesla is in the process of reducing staff by 10%. Netflix is laying off 3% of its workforce. Coinbase announced cutting 18% of its full-time employees. Redfin laid off 8% of its employees. Snap will lay off 20% of its workforce. And Robinhood lays off 20% of its staff. That's just to name a few, and we've already seen a slight increase in unemployment claims. But given these recent moves, that could easily jump in the next few months. As job opportunities dry up, employee bargaining power, it's really starting to shift. Following the Great Resignation, the Great Regret is likely to get more headlines. Some employees have realized that the grass isn't always greener. And now it looks like there are fewer opportunities in many industries. I even shared in my last video that I was let go in a second round of company layoffs from my full-time gig. That was after more than 6 years at this company. And feel free to check out that video. It might give some useful insight on a topic a lot of people just don't want to talk about. Now, to touch on a few more quick indicators, venture capital funding, that's really dropped off. Consumer confidence, it isn't looking good. And for another big one, advertising spending, it's taking a huge hit. Listening into the recent round of earnings calls, it sounds like there's a lot of downward pressure picking up on many fronts. Many telling indicators are pointing towards a downturn. It's a lot to take in, but now more importantly, what good is all this info? How should small investors be taking advantage of it? Well, first off, I always want to reiterate, or just iterate. Is reiterate redundant? I want to emphasize that it's important to build up a safety net first. And that's generally recommended to have 6 months of living expenses in cash or near cash investments. The current downturn, it's going to be a rude awakening for likely tens of millions of people in the US alone. Downturns are inevitable, and when times are good, it's smart to set aside some extra savings. It's not always fun, but there's a lot of value to living below your means. Then with any excess savings that you're not going to need in the next 5 to roughly 10 plus years, it makes more sense to invest that. And for the long term, stocks are one of the best places that you can park your hard-earned savings. Over much longer time frames, stocks have outperformed pretty much all other major asset classes. With that in mind, we've seen the S&P 500 drop more than 20% over the past year. Investor fears have picked up, and it doesn't feel like a good time to invest, but it really just means that we can buy in at better valuations than a year ago. Now, on one hand, my stocks that I've already invested in, they're down close to $100,000, and that really doesn't feel good. But on the other hand, I'm kind of happy that I'm going to have better buying opportunities. I've kept some extra cash on the sidelines, and I hope to invest most all of it in stocks in the next few months. After this downturn, I hope to have roughly 90% of my life savings in the stock market for the long haul. Of course, stocks can always drop further, and looking at the PE ratio, They still seem a little expensive historically speaking, even just over the past few decades, where PE levels have been more elevated. And on top of that, as always, it could take multiple years for stocks to hit new highs. There was even one stretch that ran close to 10 years. But I'm prepared to weather those tail events. Looking at the very long term, the US economy has not only survived, but it's thrived after multiple world wars, a pandemic, actually 2 pandemics, and plenty of other market shocks. Thanks to the power of compounding, those past events barely show up on this chart, albeit algorithmic chart would give a better view, but maybe I'll go into more detail on something like that in the future. I'm playing the long game, and that generally is where the value is added. So I hope you'll join me for some of the journey. I hope to share more specific investing research soon. So thanks for tuning in, and I'd really appreciate it if you just tap that like button down below, as well as subscribe. Also, please let me know if you have any comments down below.